We're now going to begin to look at the idea of multiple time frame analysis. In this lesson, understanding different time frames, the learning objective is you should know the pros and cons of different time frames. For new traders, the concepts of multiple time frames can be very confusing, but once you learn how they work, you can decide how best to use different time frames in your own trading strategies. Every trader is different. Every one of us has different personalities, so you must find a style of trading that fits your personality. Some of us need the excitement that comes from trading in and out of the market multiple times a day, while others are okay holding one trade for days or even weeks if it means a larger profit. To choose the best time frame, consider what your trading style is and what trading strategy you wish to follow. These should influence the appropriate time frame to be trading on. First, you should know what time frames are available. On the screen now you have the standard time frames here. Longer time frames allow traders to see a bigger picture of the currency pair to get an idea of the general trends or the sentiment that may exist, while the shorter time frame can be used for timing entries into the market. Technical analysts tend to select a range of multiple time frames in order to be able to assess the currency's pair short, medium and long-term trends and other price action behavior. Often, new traders can get conflicting views of a currency pair when examining different time frames. For example, while the daily chart may be showing an uptrend, the hourly chart can be showing a downtrend. This confusion can cause problems when attempting to line up trades. Therefore, it's important to plan the time frames you wish to trade in accordance with your trading strategy. Although you have standard time frames, there are a plethora of other options to choose from. Platforms even allow you to modify the time frames available to you, so you can change it to anything. You don't need to use obscure time frame variations because they are counterproductive. This is because the reason price action works is because enough traders see the same thing at the same time. For example, if enough traders are watching the same key level combined with the same bullish price action, chances are the market will rise and those traders will begin to buy. When you start to deviate from the most watched timeframes, you start to isolate yourself from the rest of the trading world. As an example, let's assume that 1,000 traders are watching a bullish engulfing pattern form as a key support on the 4-hour chart, but only 100 traders are watching a similar pattern form in another market on the 8-hour chart. Both markets have the same number of total participants. Price is more likely to move up in the market where there are 1,000 people acting on the pattern compared to the market with only 100 people acting on the pattern. This is why you should just trade the standard time frames. But how do you decide what is the best time frame for you? Selecting the best time frame to trade forex will really depend on the trader's level of experience, the type of trading strategy they employ, and how they approach the forex market. Initially, taking a swing trading or longer term outlook is generally recommended for newer traders, especially since their reaction times tend to be longer due to their relative inexperience in the market. Short-term trading is considerably more difficult and usually takes quite a lot of time to master, since you need to improve reaction times and emotional intelligence to the point where you can become successful. Please take this advice. I cannot stress how often new traders will come to me, ask me for advice, and then just immediately ignore me, and then go straight into trading as low as 5-minute time frames, just to lose their money and think the whole market is rigged against them. The shorter the time frame you trade in, the more market volatility you can experience. The incidence of trading mistakes also tends to increase with trading frequency and the need for quick reaction times. More often than not, a higher number of trade setups equals a higher percentage of false signals. So until the longer time frame analysis is mastered, a newer trader should generally avoid trading the shorter time frames. There are pros and cons of the different time frames. Let's look at short-term time frames first. The pros are you get more trade opportunities by only needing to hold a trade for a short time. You also won't be holding trades overnight and have the fees and possible reverses when you're not watching. The cons are though, you can't really employ a strategy as the moves happen too fast for analysis and setups. The trades are small and more numerous, so your fees will be higher due to frequent trading. Moves happen so fast it can be easy to get stopped up by spikes and small reversals. The trading will be intense due to quick short moves and the need to have amazing timing. For medium time frames, the pros are you'll be able to use solid trading methods and have the time to analyze the trades, and you'll have the opportunities for multiple trades within a day. Also, moves are slower and you can usually see reversals or stalls and have time to react intelligently. But there are cons, and these are you'll still have more trading fees because of frequent transactions, and your entry and exits may not be precise. For long-term time frames, the pros are the chance to look at longer-term trends and make larger amounts of pips. You're less likely to get stopped out because of reversals or sudden market changes. You have more time to watch the trade and make wise, less emotionally driven decisions. You'll have not as many trades made, so there'll be lower transaction costs. And the higher time frames are much smoother and consistent than the lower time frames. The cons are there'll be less trading opportunities. Trades will be held overnight, so you are subject to those fees. With less trading opportunities, you need to make sure that your system works really well on the longer term time frames, as you will naturally get fewer setups, so fewer opportunities. There is no right or wrong, best or worst time frames to trade on. You use the time frame that works best with your trading style, but just because you concentrate on one particular time frame doesn't mean that others won't be of great benefit to you. Take the time to observe and understand how they all work together, so you can be as successful a trader as you aim to be. Different viewpoints can be formed when switching between different time frames on the same currency pair, and this can either benefit or hinder that analysis. Therefore, it is crucial to have a solid understanding of forex trading timeframes from the very first trade.